Welcome to the Big Skinny with me, Lou Basenese. Is SpaceX going to be the best IPO opportunity ever or the biggest bomb that anyone's ever experienced? Are we going to live to the age of 150 or more based upon the latest medical innovations? And what's up with this AI trade? Is it over? We're coming on air here. Dell's up 22% after hours, 150% year to date. Is it a buy, a bust waiting to happen? We're covering all that and more on tonight's episode of the Big Skinny. If you're joining us for the first time, we got a unique style here. It's all filling, zero fluff, and we do everything we do 1-1-1. One headline at a time that you should probably ignore because the consensus usually gets it wrong. One chart you should absolutely pay attention to because the data seldom lies. And one investment insight you can use, at least one, during every episode to increase your bottom line. Hey, yo, to Boulder Kid 166. That's right. We're live on air. Let's go. Violator 2020. Been a few weeks since we've had you here. Let's get the Lou crew assembling. That's right. Join the conversation. We're live streaming on X and YouTube. Inevitably, we're going to get someone that types in, is this really live? Look, if it pops up on the screen, we're really live. You can send us whatever you want. Biting criticisms, questions on AI stocks. Call me out on predicting SpaceX IPO is going to be a bust before it's a boom. But don't forget to be part of the action here. Along the way today, we've got a lot of special guests because we have one core tenet that we operate by. Be humble in the markets. You're going to be humbled by the markets. And we do that by bringing on people that are way smarter than us in areas of the market that they can lend their expertise to give us profit opportunities that we would otherwise not know about, not understand, and not capitalize on. And tonight, I'm very pleased to have with me one of the brightest minds at Barron's now, Josh Schafer, Investor Circle newsletter editor, been a frequent guest on Fox Business. That's how we cross paths. He's going to break down why you shouldn't be freaking out about more volatility in interest rates. He's going to share some AI trades that still have plenty of legs and whatever else is on his mind because he's one of the sharpest ones out there diving in every day of every week into what the market's doing. And then after that, we're going to be joined again by the CEO of Gain Therapeutics. If you don't know about Gain, this is a small cap biotech that is advancing a drug in phase 1 into phase 2 that has shown the first promise of not only arresting, but restoring some function in Parkinson's patients. Just released some fresh data earlier this week. Gene's going to give us the context and the color that matters so that you can understand why the biotech innovation space could be one of the best ways to outpace inflation and more heading into 2027 and beyond. So without further ado, let's get to this week's rundown where I lay out the thing that I think is the most important before we get to those great insights from Josh and Gene Mack. So let's get to the rundown. Coming out swinging like Rocky always does here. Could humans live to the age of 150? Is that just science fiction or the hope of biohacking billionaires that are pouring record amounts of money into blood transfusions and all other manner and sort of newfangled treatments? Or is this real science that's going to lead to real success in extending life and giving us, well, a new reason to do much better in investing? Because if we live to 150, your retirement assets are going to have to last you double the amount of time that you anticipated. So Nature putting it out here, I think a fair question. Could we live to 150? Some top researchers think so. Look, we always like to be ahead of the curve. So if the men and women that are on the forefront of innovation and science are saying it is possible, then I think we need to pay attention. Barron's running a similar headline, live longer and better. Does biohacking really work? I want to dispel any rumors here. I'm not talking about biohacking. I am talking about true longevity because of medical breakthroughs, 2 huge ones in the last 2 weeks that we'll talk about, that lead me to believe in the next 5 years, the next big trend after AI, but before space discovery and exploration, is going to be cures for the incurable diseases. A couple years ago, there was a drug that got approved that cured juvenile diabetes in 40% of patients. We're seeing amazing success in other areas of the market. AI is accelerating that drug discovery. So what are the experts saying, right? Great quote here that there's a lot of progress, a lot of noise, and I mean, a lot of progress, a lot of knowledge, and 10 times more noise. I want to do you a favor tonight and sort through some of the noise and point at the real signal. Another great quote here from a lead scientist at a Dana-Farber Cancer Institute. It's really provocative. This is the leading indicator that GLP-1s showed in several instances in cancer indications that people that are taking these drugs seem to have a lower risk of the cancer returning. So this is the trend and the data that I want to use as a lead into the miracles, quote unquote, that are going to be pure science. Eli Lilly was the first thing data that hit recently 2 weeks ago. Retatrutide, their GLP-3. So again, I could bore you with all the scientific terms between semaglutide and terzepeptide and retatrutide and what works and what doesn't, why Novo Nordisk is a value trap and why Eli Lilly is the one to own. Here's what I want to focus on. We are doing things in the human body that are not synthetic, that are not drug induced. They're actually the amino acid chains that lead to protein production that allow the body's immune system to do what it was built to do. That's what you're seeing with Eli Lilly and their next generation GLP-3 drug. It's better or on par with bariatric surgery. So imagine taking shots instead of undergoing surgery, dropping weight in an 80-week study by 30%. So, yep, the side effects were a little bit higher, but here's what we're learning. Retatrutide has got a lot of downstream effects, just like we're seeing with the other GLP-1 drugs. The indications that it's helping treat keeps expanding. So these are not one size, one indication only. We're talking about things like sleep apnea, cardiac disease, addiction, food addictions, drug addiction, alcohol, getting into the neurodegenerative diseases. So this data dropped last week. And then this week, Eli Lilly showing why it's the first $1 trillion big pharma company and likely the first $2 trillion big pharma company, dropping data for their LDL cholesterol drug. That's the bad kind of cholesterol. You don't have to sort through all the data and noise here. All you have to see is all these bars are going down. Each bar represents a different level of dosing. What's most interesting on the chart on the right is after 14 days, there's a dramatic drop. Only 14 days of this treatment. It was a single one-time infusion, and you're dropping LDL cholesterol, the bad kind again, from 40 to 60%. Folks, this is screaming a cure potentially for LDL. Now, full disclaimer, biotech's always risky. You got to go through all the clinical trials, but this is a drug that could be on the market within the next 12 to 18 months and eradicate one of the biggest killers out there, cardiac disease, right? Costs $80 billion a year in hospital fees for false alarm heart attacks, but then also for the treatment of that. So what does this mean? We always boil it down to one key chart. The money chart is this: innovation doesn't care what the global economy is doing, whether the Strait of Hormuz is open or closed, how long or how many people are empowered, Republicans versus Democrat. The innovation economy never sleeps, and it's never more true in big pharma, because this chart shows if they don't keep innovating or acquiring innovations, they're screwed. The percentage of revenues that's going to go off patent and exclusivity over the year. You look across the bar here, some of the biggest names in pharma: Merck, Amgen, Bristol Myers, Biogen, Pfizer, J&J, Gilead, Eli Lilly. The average here is about 35% of their revenues need to be replaced by 2031. It's a total of $170 to $180 billion. It's going to be replaced by multi-billion-dollar new drugs like retatrutide, the Verve 102 LDL cholesterol drug. So what's the action to take? It's very simple. This is the insight. I've been banging on the table for Eli Lilly before. It's one of the bigger contributors to S&P 500 earnings. That's a non-tech name. You got to keep buying Eli Lilly. This is a name that I think can add another $1 trillion in market cap on the success of these two new drugs, as well as the pipeline that they continue to build out in other indications in oncology. They've made 6 different acquisitions already this year. Look for them to continue using the cash cow from their GLP-1 franchise with Zepbound and Mounjaro. That's the terzepeptide. So if you want to think about these GLP-1s in your mind, quick science lesson: semaglutide is Novo Nordisk, single. It targets one receptor. Terzepeptide is Eli Lilly, T2. Retatrutide, I don't have an R word that stands for 3, but you get the point. This is a company that is going to lead the trend, the longevity trend, based upon their developments in the pipeline. I think it has to be a must-have in your portfolio, just like an NVIDIA is for the AI trend. They're building out that ecosystem. So you heard it here. You'll hear it here again. We're going to bang the table on it while it continues to be a fast growth, continually innovative company. Make sure you have some in your portfolio. Do your own due diligence. It'll prove out to lead to the same conclusion. And with that, we're going to get right to our first guest very quickly. But first, a short break and a reminder to follow us on socials. If you're not already, this is where you get reminders of all the episodes we're dropping, not just our live streams or our insights, are on Twitter. That's right. I'm going to keep calling it Twitter until Elon Musk follows me, which he probably won't after this episode when I bash SpaceX IPO. But hope springs eternal. Insights there on X all the time, and as well on YouTube. We're trying to be as fraction of as popular as Mr. Beast. If you could follow us there, hit the subscribe button, Make sure you never miss a notification for when we're going live and dropping new conversations. We've got one going every day this week and next week. So a lot of insights and alpha headed your way. And with that being said, we got even more insights coming right after this quick break. Josh Schafer, Barron's reporter and investor extraordinaire, who's going to blush because he's right next to me and I'm giving him lots of kudos, but he's a sharp mind that you're about to discover right after this.
What's going on with Eli Lilly's, this is important, next obesity drug?
Yes,
next generation
is incredible. So some phase 3 data that they are just releasing shows that the average body weight loss for that next generation drug is about 28% in an 80-week period. They said half those patients lost 30% or more. They're saying that matches
of their body weight.
Yes. And that 30%. Matches the efficacy of that invasive bariatric surgery.
So you can get rid of surgery
They're
now.
saying that this is working.
Put a fork in Novo Nordisk. This is a value trap. Eli Lilly has superior biology. I've been saying this for 6-7 months, Taylor, and I've been talking about it. Retatrutide is a drug that came out. It's a GLP-3. It targets 3 different receptors. If you want to think about it simple, Novo Nordisk has semaglutide, Ozempic, Wegovy. It targets 1. Eli Lilly, tirzepatide, targets 2. Retatrutide is Eli Lilly's next generation. It is doing better, double the weight loss rate than you see with Ozempic and Wegovy. This is going to dominate the market.
There's another narrative going on with these drugs, microdosing them with longevity in mind. Because you're the live forever guy. Look, I have them sitting in the fridge. I've got the needles. I look at them every day. But this messing with receptors in your brain stuff, I just can't do it.
So, but this is the thing. They're peptides, right? So they're amino acid chains. So it's just stimulating a natural immune response. And that's why we're seeing all these downstream positive health effects.
There's one more very important stuff. Every day I look at the needles and I reach behind them to get the wine out. That's what happens.
That'll help with longevity.
That's what you need.
Kevin O'Leary, the longevity guy, is reluctant to adopt retatrutide, but you shouldn't either. And you shouldn't be reluctant to buy stocks in a high interest rate volatility world. You should be looking at, say, some AI names, including Micron and NVIDIA. And tonight's guest is not going to talk anything about biotech. He's going to talk about those topics I just shared with you and give us his insights. It's a pleasure to welcome Josh Schafer to the Big Skinny in studio, live in color, my friend.
Yeah,
you're too young to remember in living color, I bet. I meant it when I said it, man. We met first across each other, I think, on the Big Money Show.
Yeah. Killer insights. You write a Substack where you're sharing every week some insights on the market. You always have a chart that's instructive too. So I love that approach. You were writing recently about interest rates, higher interest rates, and the headlines are that these are bad for stocks. You got to watch out. That's not exactly true. What have you found?
No, so it's not always true, Lou. So I think popular knowledge over the last several years has been 4.5% on the 10-year yield. Oh no, for stocks. This is
freak out.
This is not good. And I will say that has played out plenty since the bull market started in 2023. It really has been a level to start get concerned. But really, it's less about levels and more about rate of change. Okay. And that's true for really economic data, interest rates, a lot of things, right? But when you look at sort of what the equity market has moved with the most when we think about interest rates, it's actually the MOVE index, which is volatility within the bond market.
Okay.
And what was interesting was, I think it was last week now. I get lost after the holiday week. Last week was the 30-year hitting its highest level since 2007, I think.
Yeah.
And so you had that big bond market sell-off, and it was, oh no, here it comes for stocks. This is going to stop the recent rally we've had. Well, it didn't.
Right. The next day, right?
The next day we hit a record high.
Yeah.
And it was because volatility actually wasn't that high within the bond market. We started to hit levels where we could put a nice headline on it and say, okay, the 10 years at its highest level in 8 months, the 30 years at its highest level since 2008, 2007. But it wasn't rising that rapidly. It was sort of controlled. And that seems to be what freaks out the market a little bit more.
Yeah.
The other thing I'd argue at this point, you have to just be wondering if any risk that I'm going to write about and tell you about really interrupts the AI capex cycle. Because if it doesn't, then maybe it's not that big of a risk. I think we learned that with the Iran war, the quick V-shaped recovery. You learn that with tariffs. I would start thinking about every macro risk and just essentially asking myself, does that ruin the AI capex cycle?
Does it derail it?
And if the answer is no, then maybe it's not that. Maybe it's a short-term headwind.
Right.
Stocks don't go up every day.
Yeah.
But is it a secular headwind that's going to ruin the bull market?
I think that's a really distinct point, is like, you got to put it in the context of where does this risk impact the biggest driver of what's, behind earnings right now. I mean, the Mag 7 earnings were up 60 something percent this quarter. Insanity, right? I mean, after 3 quarters in a row of 20 plus, but I want to bring back to the interest rates too. Do you think, and this is going to be a trickier question because you are part of the financial media, and I don't want to label you that because you haven't been a journeyman there yet,
But do we obsess too much over the 10-year and the 30-year yield at the levels, as opposed to, like you said, how fast did it move up? How fast did it go down? Because that indicates capital flows more than anything.
Oh, I think so. Definitely. I think in general, my advice would be on a daily basis, looking at a stock market blog from any of the wonderful websites that I've worked for and just saying, oh no, that risk that they're talking about is really, really important. This matters a lot. Sort of. Some days it does and some days it doesn't. You're always trying to come up with a reason for why the S&P 500 moves some small amount every day. And some days, honestly, we could debate it, right? That's the point of the market, I think, is I could tell you it's because of what's happening in the bond market. You could go and look at some other totally different correlation and argue that that's why stocks are moving. That's kind of the beauty of the market, is there's always that debate. But I do think sometimes those things do get overblown. I think when it does start to get a little more concerning, just from a risk sentiment perspective, is I've been using this framing a lot of generational highs. So if you get back to a 2007 type level, that was when I think the 10-year really started to weigh on the market it was 2025, early 2025. 10-year was near 5%. You have an entire generation of investors that have never considered, oh, the risk-free rate is at 5%. Should I be allocating money there instead of in the equity market? It's a new investor question for an entire class of investors, and it becomes important.
I think it's a great point, but there's also a nostalgic period too for the guys that were in the markets 2003, 2004, 2005, where, oh, I can earn a real respectable yield on my cash. So you better have a hurdle rate of a great investment. But like, AI is serving them up left and right. We were talking before we came on air. Dell up 22% after hours.
It's crazy. And so I think that's also why you're struggling to maybe get some of that money to move into the fixed income market. You get these attractive yields, you get a bond market sell-off, but I keep watching the equity market move higher. I think it's tough to maybe talk to investors at that point and say, we should be clipping some bills here. Like, should we? I don't know.
Come over here and get 5%. Which brings us to the chart that you shared too, because I think fundamentals always win out at the end of the day. And you've got a chart here of Micron showing its earnings over stock price. The other thing we talk about here, one fundamental, the pillar, is be humble and the markets will be humble. The other one is stock prices ultimately follow earnings. So to your point, if we bring up the chart here, it's back to rally mode for Micron. What do you make of this? Is this sustainable? Are earnings going to keep going up at these nice, impressive rates, driving the stock price higher?
Yes. If you take a look at that chart, the orange line there is your stock price. The blue line is the earnings estimates. You can see earnings led, and then all of a sudden the stock price sort of caught up to it because analysts said, oh, wow, that was back over a month ago. I just like that they're both hockey stick shaped too, I will say.
Are you a big hockey fan?
Yeah, I grew up playing hockey. I'm a Boston Bruins fan, love hockey, and I just love a hockey stick chart. But it was interesting to see the earnings also do that. And what I think this sort of explains, Lou, and I'll be writing about this in my Substack this week, you look at Micron at the start of 2026, it had already been up 250% over the past year. And there's been so many of those charts that we point at and we say, how can it go higher? It can't go higher from here. That doesn't make sense. Well, how does it go higher? Last year at this time, analysts estimated that Micron would earn $11 per share in 2027.
And what is it now?
Over $100. It's at
Wait a minute. $11 last year at this time. And over $100.
That's what that blue line is showing. That's consensus.
So I guess the question is, it's twofold. Are analysts woefully just wrong? Are they out of touch, or is just everyone not understanding how the rate of change with AI adoption?
I think people totally missed the memory part of this trade. I mean, if you look at, it's not just Micron. If you look at SanDisk, if you look at Western Digital, that's why you're getting such ferocious rallies within these companies, is because people did not understand the demand shortage. We were ready to move on to the next part of the AI cycle. It wasn't the AI infrastructure trade anymore. It was, okay, what software companies are going to be able to monetize this? Where's monetization? Notice what we're not talking about that much anymore, monetization. It's back to AI infrastructure. Where's my next build out play? And so I think you just saw a massive chase in a lot of those chip stocks, and especially in memory.
So I love this analysis on Micron, and let's anchor that back to NVIDIA, right? The king of the AI trade, trading the cheapest it's been in a really long time, and yet earnings like through the roof. And Jensen Huang projecting like, hey, it's going higher from here. We have $1 trillion worth of demand that doesn't even factor in China. What do you make of the trading activity in NVIDIA? I've had some guests that talk about like NVIDIA is kind of those sleeper, trade sideways for a while and then explodes and then goes, consolidates. Do you think it's poised to happen here, or are people just reticent to accept it's a $5.5 trillion market cap company? How much higher can it go?
We still like NVIDIA here. So at Barron's, we picked NVIDIA a couple weeks ago at the Barron's Investor Circle. And really part of the reasoning was that valuation that you pointed to. I think depending on the day that you look at, it trades at like 18 times next year's earnings. And that's below the market multiple. It's not trading like a growth stock. But if you look at the growth metrics, what I think is the most fascinating chart right now with NVIDIA is just simply look at the year-over-year growth of revenue and year-over-year growth of earnings per share. It's accelerating again.
Yeah, again.
The last couple quarters, it started ticking back up. They grew revenue by over 80% year over year. They're now estimated to grow that again next quarter. It is a growth stock that is not being priced like a growth stock. To your point, from a market cap perspective, over 5 trillion. Do I think it's going to have these massive moves that we used to see 2 years ago where you're going to get a 20% rally in one day? Probably not. That's a lot harder to do at this point, but I think it's a good grower that you can be in if you want to stay in semis. Own best in breed. That's advice you hear often. And if you're worried or not worried, if you're interested in the concept of demand still being higher than supply, buy the best supplier.
Yeah. No, dude, I agree. I think it's always a land and expand. I talk about thematically land with an ETF that gives you exposure and then expand into individual names that give you leverage. But if same in AI, like why not own NVIDIA, just like own Apple? I mean, remember when Apple was trading at a lower multiple and then it re-rated, right? Because when services, there's always an inflection point in the business where investors go, oh crap, we got to re-rate this thing, like we're seeing with Micron. I mean, what do you think is that trigger for NVIDIA? Do people need to see China sales come back on? Do they need to see one more quarter of ridiculous earnings and revenue growth? I mean, or is it the dividend? Like, talk to me. What do you think about the dividend going from 1 penny to 25 cents?
I think the dividend may be going even higher than 25 cents because they're certainly capable of doing it. Would be interesting. They have that growth now happening in the CPU business. Does that continue to grow more? I also think maybe it is China.
Yeah.
At some like that is fully priced out of the stock at this point. It seems like. Are they able to actually sell some of these chips in China? Is there demand for the chips in China? Are the Chinese companies? That's the other question here. There's a lot of back and forth about, can NVIDIA sell the chips? Are they going to sell the chips in China? Well, they still need someone to actually want to buy them too.
Right.
So is there going to be sales growth there? And then, I mean, if you really start zooming out on NVIDIA and you think about it, if you're going to be a long-term investor, only 5-10 years, they want to be heavily involved in the quantum play. They're going to be involved. Jensen's talked a lot about being involved in autonomous driving. Think about how early you are in the autonomous driving cycle. How do they get into those next lines of top line growth? If I was a long-term investor looking over a 5-10 year horizon, I'd start thinking about how NVIDIA fits into some of those stories.
Do you think so? Like Beth Kindig, who's been very early on to a lot of big names, thinks NVIDIA originally could go to 10 trillion, but now thinks 20 trillion is there. If over the next 3 to 4 years, they can grow, you know, at a compound rate of 25% earnings. Do you think that's in the realm of possibility, or is that a Cathie Wood-esque, let me project the best case scenario forward and hope that people start believing it and then help the performance out?
20 trillion feels a little high to me. It's simply because another thing I'm thinking about for a theme for the rest of the year is simply the supply of shares that are available to investors and the demand that you're going to have. And when I'm talking about supply, I know you're going to talk about SpaceX later. But if you have SpaceX, Anthropic, OpenAI all come public, you're going to have a lot more stock in the market. And so how much demand can you really have to push all of these things higher? Maybe some of those stocks don't catch a bid, but at the end of the day, for it to get to 20 trillion, you just simply need a lot of money to buy.
Everything's got it's got to take on another Palantir cult-esque following to get that. Before we run and let you go, any other things that I always like, because you're a deep thinker, you're a trend follower and spotter early, is there something else that you're starting to pay attention to more that you think is going to be a trend worth investing in or risk worth tracking that is not on everyone else's radar just yet?
So I'll highlight 2 things, because one of them I was just thinking about back in my office, and I actually want your take on. But I'll start first.
You're not allowed to ask me questions.
No, I'm going to. You know, I host sometimes. I can't help myself.
I love it.
To start, what other ways is energy and the energy demand not being appreciated in this market to this point? So one, we actually picked an ETF a little over a month ago now. It's up 20%. Invesco's solar ETF.
Okay.
Part of the bull case for TAN is the ticker symbol TAN. Part of the bull case there is simply there's so much energy demand right now that even solar energy, which totally fell out of favor, is going to need to play a role in this. And especially too, when you think about the oil price shock, that's obviously a catalyst for that as well. Do some businesses just start rethinking how this whole modeling works? And maybe we can start moving to some solar because this demand is going to be so aggressive over time and going to be so sustained, that is there other energy demand areas that you can start sort of picking at? So we didn't want to pick. Solar can be a little volatile, maybe
definitely.
a little bit harder to pick a single name. So that was why we do some ETFs. We haven't done a ton. But we thought, okay, let's make a sector, or sorry, more of an industry play within it. I offer you my second one. You want to go solar?
No, dude, I can go solar too, but offer me your second one.
Why is Bitcoin at 73,000?
Why is Bitcoin not at 10,000 or 10 million? I don't know. I would tell you that why would I put money in Bitcoin now if I can get 22% return overnight in Dell? Like the speculative crazy behavior that happened in Bitcoin, in my opinion, is now manifesting in individual stocks, which is adjacent to the fact that Bitcoin has now become institutionalized. We've taken the friction on the on-ramp to Bitcoin out, where now Wall Street can own it through last year, 2 years, DAT strategy craze. Now we can own Bitcoin through a common stock vehicle. So I just think the volatility has gotten pulled out of it because it's more been institutionalized.
Yeah, I don't think Bitcoin really joins this risk on rally was going to be my take because of that reason. I've been talking to more and more people about it, and I keep saying, I feel like the marginal buyer in Bitcoin just went somewhere else. At the beginning of the year was metals. I mean, let's be honest, that was not all institutional gold bugs that wanted to buy gold and silver and push it up that high.
It was a momentum trade.
And it becomes speculators. You now have prediction markets that are sucking some of that speculative money out. And then you have these smaller stocks. I'm watching some of these quantum stocks start to take off. And you just see people want to participate more in the equity market and not necessarily in Bitcoin, which does have me worried about some of the more Bitcoin tied stocks too, that in the past couple of years, when things started to get frothy, Coinbase would do well. Robinhood would do well. I mean, this is still a decent environment for Robinhood, but some of those crypto tied equities that usually had been participating once things really start to blow off, which feels like it's starting to happen right now. I don't know if that happens this time because Bitcoin is price driven.
I agree, because you see it in Robinhood's results, right? The volatility between crypto driven revenues and equity driven revenues on a quarter over quarter basis determines, where the stock is going. So, we're running out of time. I'll answer the solar thing quickly. Yes, because I think it's not an energy transition, it's an energy addition. Everything, all of the above. China's doing coal, solar, we need it. We just don't have enough energy to supply the 3 billion energy poor in the world that need just the basics. Like my favorite stat here is like the per kilowatt hour consumption per capita for most African nations is like the equivalent of what our individual refrigerators consume each year. So think about that. There's 3 billion people in the world that don't consume more electricity in their life than your refrigerator does in a year. So they deserve energy. Every AI deserves energy. So I love that trade. I think
add in a data center to that instead of a refrigerator and think about how much energy is being taken.
Well, listen, I thank you for coming in studio. I want to make sure everyone here listening in, follow Josh on X as well. Check out his Substack where he's writing insights every week, keeping you ahead of the curve, all signal, not much noise. There's occasionally, but he's always ahead of the curve. Look for him on Fox Business. Check him out at Barron's. Thank you for joining us.
Appreciate you having me, Lou.
All right. Next time, we'll have to get into some more picks. We'll be right back after a quick break.
Lou, come in here, please. We're going to get to you early with your stock picks. This is worth it. Teradyne.
Yeah, this is one of my favorite stock picks, AI picks, that's not named NVIDIA. They make test and equipment, chip test and equipment, so they have to quality control and inspect every chip that goes into any electronics, not just AI. They pivoted to AI a couple years ago, and now it's generating 70% of their revenue. Another interesting fact, they're getting 16% of revenue from robotics. So while Tesla's out there claiming they're a robotics company, Teradyne's actually generating revenue and profits from it.
What did you say they were getting from their AI business?
70% of the revenue in the last quarter was from AI test and equipment.
They're an
sales.
AI company.
They're an AI company. I mean, the stock's up about 300% in the last year and a half, about almost doubled this year. I think this business has legs for sure, because it's not just about AI. It's about the digital economy, and chips are the oxygen of the digital economy. Today it's AI. Tomorrow we don't know what it's going to be, but you're going to need Teradyne to test whatever you make.
All right.
Welcome back to the Big Skinny with Lou Basenese. I could have talked to Josh for at least another 20 minutes, pick his brain on just other areas of the market. So we promise you one investment insight per episode. So we gave you way more than that already. Eli Lilly, NVIDIA, Micron, a solar ETF, probably not Bitcoin. We're going to talk about whether SpaceX is worth it or not. We got VKP 2403. Thoughts on ServiceNow with SaaS possibly rotating back. Look, I think the software space is definitely going to see a resurgence. We knew it was happening. We just didn't want to catch falling knives. So I think here's interesting. I don't want to play pick the one that's going to rebound first and fastest and the most. We talked a couple episodes ago about the equal weight software ETF. I don't remember the ticker off the top of my head right now. That's how we're playing it, by getting exposure to these beaten down names that are really just retracing and retrenching to figure out what's the new model. I would argue the report coming out from Salesforce, where they had good results, they had a little bit weaker guidance. Investors are concerned about whether they can have the model where they can charge with AI just increasing productivity per seat licenses per employee. I've told you a couple weeks ago, Microsoft, I believe, is on the cutting edge of figuring out how to reprice the model. And instead of per seat per employee, it's per seat per agent. I think you're going to see that happen and carry out through the software industry. So I think that's going to lead the charge back to those like higher valuations that we've typically associated with SaaS. So we definitely want to be paying attention to the software space. I'll dig into ServiceNow a little bit more in depth before next week's show, but I definitely think you have to have exposure to software now. We're seeing that show up in the results this week for those software names that were beaten down, battered, and bruised. Those are the types of places where we can make easy money in the market, like we did in energy, like we think the setup is in biotech. And without further ado, let's pivot to one of the more compelling biotechs that I've seen in a long time. Gain Therapeutics, the CEO, Gene Mack, joining us remotely. I'm mad because he's not in studio next to me like he typically is. But Gene, good to have you back on the show. You can't be smiling, dude.
Always great to see you. Always great to see you. Listen. Although I don't know if I'm getting enough oxygen to my brain with these buttons. So inside joke for your.
It is a great inside joke, and if there's any trolls that are ready to troll us, the conversation is live streaming in living color. If you want to ask questions along the way, I've got some for you based upon this week's press release. With, I would argue, for me, was just validation of the amazing data you had already reported. We've got the headline here, but basically you're providing extended data on the patients from the phase 1 trial now at 150 days, measuring their scores. I don't want to mess up the acronym. It's the MDPRS score. I'll just say it really fast and maybe I got it right. But this is the measurement for the progression of Parkinson's, and it typically declines by several points over the course of a year, and you're seeing stabilization. Talk to us about the headline, the results, and then let's dig into it a little bit, why it's so freaking significant and that people are missing the boat on.
Yeah, so there's 4 or 5 things that that we're hoping to get across from our data. First, of course, the biomarkers, right? They're still there, and they are still, the same significance for us as they did when we first found them. And there's 2 of them. And they give us good confidence that what we're seeing in the MDS-UPDRS scores is indeed durable for a good reason, because we are hitting the disease at its biological roots. So the MDS-UPDRS scores are validated, in our view, by those biomarkers. And yeah, we're seeing good durability there. And we're really pleased with that. And as the patients continue to stay on drug and they continue to do better, the way I've been telling this to my board and some other shareholders is we're still in the black with all the patients. We have this sort of differential biomarker. I don't know. I don't want to run ahead of what your questions might be, but we have this sort of differential thing where patients at a high level of a particular biomarker in the cerebrospinal fluid seem to respond a little bit more robustly than those that had a lower level of this particular.
So that could be a pre-screening biomarker to identify which patients could respond better or the best to.
Exactly.
Let's talk a little bit about things that are tangible that I think investors really should focus on, because these are quality of life type things for the patients that you're treating, right? You're seeing just steady stabilization of the scores, but then also the restoration of smell. What other things, qualitative things, quality of life things are you seeing in these patients that have stayed on trial?
So that's really important. And for the first time, see, MDS-UPDRS is adequate, but it doesn't capture everything. And I'm not sure that the MDS-UPDRS score will keep up with how disease-modifying therapies may impact the disease. There might be some modifications that have to happen at scale. I'm not in the field to that degree. I don't know. That's my own personal opinion. Yeah. But what we saw in the phase 1b study across multiple centers were things like what you had just mentioned. Sense of smell got better. Their gait improved. These were patient-reported things, and that's hard to either you can smell or you can't. You can't really, and that's not something you can bias yourself into thinking that you can do again, right? So sense of smell, and also sense of smell. Unfortunately, if that is one of the hallmarks of a particular patient's Parkinson's, it's likely you're gonna have a worse cognitive outcome because of that, because of just where those centers are in the brain. So anyway, sense of smell was one. Gait was another one. Some people reported a little bit better concentration, but smell and taste came across and gait came across. So, and one of the reasons why we reported that in this upcoming conference was we did want to check and make sure those things were durable.
Yeah.
And we went back to the centers to ask the patients, are you still feeling this way? And they did. And we have these secondary endpoints in our phase 2 study now that we're designing that go beyond the MDS UPDRS now to check these on a larger scale in a more controlled environment with larger patient group. So we're real excited about that. And we wanted to show that for the first time because we get a lot of questions. Why are you putting in, we're putting in wearables for the patients to really really finely measure their motor motor skills and control, and their rigidity. We're also going to be putting in a smell test and see if that is something that is coming across in the phase 2 study. Taste just kind of takes care of itself. But
so these early data is helping instruct the phase 2 study design to add secondary, tertiary endpoints that could be, qualitative indicators of the drug working. Talk to me about just how important is durability, right? I mean, you spent your career before running a biotech in the biotech space as an analyst. You've seen tons of drugs that might show early promise and then the results peter out over time. What's the significance of the durability, particularly in a neurodegenerative disease?
The significance is getting the patients to a point where the disease process has slowed down or stopped. That may come with a quick improvement of some kind, as we saw in our study. And then, but we really want to see no deterioration of whatever function is available to those patients with the level of neuron damage that's already been done. Again, it is impossible to bring back dead brain tissue and dead neurons and dead neural networks. We can talk about, and I've mentioned this on your show a couple of times, we can talk about if we give patients an opportunity to get into physical therapy by slowing the disease. There's a theory around brain plasticity, the brain's ability to create new neural networks.
Right.
Not something our drug can do, but it's something it can help patients do. So we really want to slow this disease down as much as possible, give patients the best quality of life for as long as they have it. We want Parkinson's to hit a wall. And then as we learn more about how those patients respond, we can move it earlier and earlier. So that the patients we capture, at the beginning of the disease, at the very beginning stages of the disease, hopefully don't notice their disease very much. The most annoying thing they'll go through is having to take GT02287 every day.
And remind people how it's administered. Is this drug an infusion, a shot, a small molecule pill? I think that's important. What's the delivery mechanism?
So it's an oral suspension.
Okay.
So you mix it into a solution and then drink it with water. But we're working on things where you might be able to sprinkle it on food, things like that to make it very easy. Because some patients have swallowing conditions and other stuff based on their motor deterioration. And I think this formulation gives us a lot more flexibility than just
but I think it's important to tease out too for most people that are not biotech familiar always that this is a drug that's easily administered, unlike other ones that are multi-hour long infusions and a pain in the ass for compliance, right? For patient compliance, because that's always part of it. This makes it really simple. Now, if you're talking about we can sprinkle it on like Mrs. Dash on our morning eggs, that's it, again, it makes
we're working on that. We're working on it. We're not there yet, but we're working.
No, I think it's important to understand not just the early signs and what it can lead to, but then the adoption becomes easier for that because you're not asking patients to do things like, I think about the GLP-1s, right? People don't necessarily want to take a shot every 4 days or every 7 days, or they forget about it. And then you see a progression of that. the reversal of that. And so
Yeah,
I want to focus on two other questions that I think always come up with investors. And one is, I always used to get the question to say, what's going on? And I would say, are you asking about the business or the stock price? Because I can tell you everything's great with the business. I can't tell you what the hell is going on a day-to-day basis with the stock price. But I think your experience, the disconnect with early stage amazing data in biotechs in general, and with your case in Gain, and the market price. Do you see that there's a lag traditionally until a certain tipping point, inflection point hits? What traditionally has been that gap closer? And then the second part of that question is, what are the catalysts that investors should be looking out for the rest of this year?
Yeah, so I think we're actually there, Lou. The last couple of conferences we went to, and I remember when you and I last spoke, we were coming out of the ADPD conference.
Yes.
I was miffed that the shares, that the stock did poorly on the back of that, but we saw the field talking about our data throughout that conference, and that was new. And I got real confident going into this one that we might not hit that wall again. And it looks like we did. We sold off, I think, a little bit, because investors probably were like, well, Gain always sells off after they put out data. But in this particular case, we're actually now lifting out of the data event, which means, to me, traction is there. It is finally. Now, why is the share price where it is? Well, we got to run a phase 2 study, and we have to pay for that. And as an analyst, I'd say everybody's waiting us out. Partners are waiting us out. The investors are waiting us out. I would say get this price while you can, because the data continues to get good.
And you're going to continue providing updates as this durability of the data.
We're through 6 months. We think we're really encouraged by what we're seeing. We don't have a placebo group in our study, but we would have expected those patients to be deteriorating by now. So the benefit we're still holding on to is against an already decline that we would be seeing in the placebo group. So we're really happy about that. And we're 6 months in, and we're going to watch the patients again at 9, and then we're going to see them at a year.
And then the phase 2 study, what's that design going to look like? Is there going to be a placebo group? I think about it this way. If I'm the patient with Parkinson's that we know, for lack of a better term, it progresses pretty aggressively, right? If we think about a 2-point decline, like, I don't want to be in a placebo. I see this data from phase 1. I want to make sure I get the drug.
Right. So we can do a placebo control, right? And then run that for a year and cross those patients over onto drug.
Okay. So you get the control, you see that decline, and then you can say to them, like, hey, if you end up on placebo, we're going to be able to move you onto drug.
Yeah, that's one of the things we can do. The other thing we can do is, there's been some, it's a very noble pursuit, but the industry has thought about doing what they call platform studies, which is where a bunch of drugs jump into a trial. And there's only one placebo group, so you're not putting a bunch of patients through placebo. There's some support for that, but it's a heavy lift with the regulatory steps that need to be taken for each sponsor's drug development. So that's where it's difficult.
Yeah.
But there are things that we're doing that the field is working on to try and lower the burden of the placebo group.
Yeah. So talk to me, what's the end game here? You talked about partners are waiting you out. So there's strategic interest. I mean, all know Biotech. Yeah. Jay Dietzer 5805 wants to know the end game as well here. Again, without giving any material, non-public information or putting yourself in a competitive disadvantage by sharing it, just to characterize the level of interest. You talked about the academic clinical interest, the community, the scientific community. But what about the strategic community? Are they paying attention more? Are you having more conversations than you were 2 months ago, 6 months ago? Characterize that for us.
I'd say that the number of conversations is the same. I'd say the players have shifted around a little bit. We have some that have said, okay, talk to us at the end of the study. That's frustrating because we feel like we know everything we need to know by now. I know what their position is. They're worried something could go wrong, like 2 days after they signed a deal. Things can go bad in a clinical trial. We're not all the way there yet, but the data is the data. You know what I mean?
Yeah, so I always say two things hurt biotechs is data and running out of capital. So you got some that are just following that, like, I don't want to go too early, but I see, and correct me if this trend is wrong, I'm seeing more companies, partners, strategic partners making deals before phase 2 or right before a phase 2 readout, because they don't want to have to pay even more when the data matures. So
I think it really depends, and it's company specific, and they all have their own philosophies.
Yeah.
There are some that are worried about a low probability event happening in our study, and while they like the data, they just don't want to do anything until we're through the window, until we're done with the study. They don't want to slip and fall, and there be a bad press release because of that. You know what I mean?
Yeah.
So there are some companies that have that sort of philosophy. Others are digging in, but we can tell that they're going back and they're trying to understand our biomarkers. So I think there's like two schools of thought. There's ones that are focused on the biomarkers and understanding them in-house and seeing what other data can be duplicated around that, might be doing their own analysis and their own studies. And then there are those that are, okay, the data looks really great, call us when the study's done.
Yeah. And so remind me, when's the study done? When's the phase 2 start? What have you publicly guided that you can share so that we can level set for investors and expectations?
We'll finish the study in the fourth quarter, October,
okay.
Hopefully before the end of October. And we're starting this, we'll enroll the first patients around the same time for phase 2. But, I said October. That doesn't mean that October is the date that they need to get comfortable. I don't know that it is the last patient. We didn't get a fine. They didn't put a fine point on what they mean by the end of the study. It doesn't necessarily have to be last patient, last visit out the door.
Right. That's a good distinction because I think people wouldn't know that otherwise. That they're under CDA, so they're gonna see data as you see it, as it aggregates over time. So awesome.
I think for a lot of companies, 6 months isn't enough for them yet.
Yeah. Yeah. No, it makes sense. Look, you get to a point though where 6 months turns into 9, and now you got to pay attention, and 9 turns to 12, and you might be late. So I think like you said, the data is trending continually in the right direction. That trend continues. It just makes it even more compelling. Listen, any other things that you think investors should be aware of before we depart and say we're going to come back at the next big news announcement?
Yeah. So the catalysts in front of us now are. And unfortunately, this has turned into a catalyst for a lot of small biotech companies. But I had said that we had a great dialogue with FDA and it was working at a good pace and things were back and forth. Well, we just got a letter saying that we were expecting to hear from them by the end of this month. They moved that to middle of June.
Just delays, nothing going. It's just their regulatory delay.
It's just the brain drain at FDA. I mean, it's again, when you think about the NIH, the FDA, like they're all seriously understaffed now.
Yeah.
And we were at a good cadence with them, and it's a 2-week delay. So
right, that's what I was going to say. We're not talking about a lot, and that, like, in context here, if you told me I got to wait 2 weeks or 2 months for a potential cure for Parkinson's, or at least the first disease modifying drug for Parkinson's, I'm doing that, right? Like it's not, So if you're an investor and you're getting impatient over that, you own the wrong thing. You should move on down the road, and we should find other investors that understand that you don't get asymmetric upside, multiples higher with minimal downside risk outside of this data. So it's a good transparency.
And the good news here is that we're already open for business in Australia. We don't need the FDA's green light at the moment, but my fear is that like waiting for a flight, right? Like this is the first delay we're getting.
Yeah.
Right? Are we going to hear from them again in 2 weeks saying, give us another 2 weeks? I don't know if that's going to happen, but the backstop we have to that is we can always start enrolling patients in Australia while FDA itself out.
No, and that's good. And then as the weeks go by, you're just getting more data from the patients that are currently on the drug.
Exactly. So we'll have more conferences in the fall. The MDS UPDRS conference in October, which is in Seoul, Korea, is going to be probably the place where we that's going to be in October. So we're going to be talking about probably having a lot of data there to go at that conference.
Awesome. Well, listen, we want to have you back on the next news announcement. That's meaningful. We appreciate you making time as always. Wish you the best of luck, and we're going to provide access to more information. Gene, always a pleasure to catch up with you, and keep fighting.
In the studio next time.
Let's do it, my friend. Maybe we end up at a Yankees game and we talk about the days that you dreamed of being a shortstop.
I don't want to talk about them right now, but we'll go. I'm one of those Yankee fans.
I love it. I love the tenacity. It carries through into the work you're doing this is the key thing in biotech. You are endeavoring to change people's lives. You're not just out to make money. So we thank you for that. It's not a easy task. So, man, we appreciate you.
Thanks, Lou. Thanks so
much.
All right.
Talk to you soon.
Take care.
All righty, folks, we're going to come back right after a short break. We can answer some questions. We got headlines and head scratchers with the Dodd man himself. We'll break down some of the scientific terms if necessary, or if I can. I can't say I always do. We don't know it all here, but we can help put it all in context. So we'll be right back after a quick break.
Goldman Sachs was named lead book runner for the SpaceX IPO, so there's really good investment banking fees that Goldman is going to get from that. They then get to be in charge of the share allocation and who gets what. So that's the one I'm excited about as well.
I am 0% excited about the performance of either of those two IPOs because they are just a liquidity event for venture.
Way to crush this segment.
No, it's a great day for America. It's a great day for innovation. But if you want to own SpaceX or OpenAI, please, I beg of you, no IPO FOMO. Just wait. Tom, back me up here. The stats are terrible for everyday Americans buying IPOs on the open.
There's an
day.
old saying on Wall Street, when the ducks are quacking, feed them. And that's what's happening right now. You've got record call buying of the likes we haven't seen since the meme trade in 2021, record overweight equities, record margin debt. And you know what? They're hitting the window for a reason. The bankers are like, now's the time to go. Let's get it out right now.
And you had the resolution of this Musk suit against Sam Altman. So everybody, I could imagine, wanted to wait for that to be over to see what the outcome would be. But they wanted to come to market as soon as possible. And Musk obviously, losing in that case. But now this will be sort of a new grudge match. Where are investors putting their money and who are they putting it on? For somebody like Elon Musk and ego issues, I think that is just fascinating.
Lou, it's only trading at 80 times sales and losing money. Other than that, how is the play, Mrs. Lincoln? I mean, come on.
SpaceX is actually trading in a perpetual futures on Hyperliquid right now at about $205 a share, which implies like a $2.4 trillion valuation. So you're already seeing price discovery happening. That's way too frothy, especially for turnaround Tom, but even for me who chases growth all the time.
I'm stealing my thunder there, calling SpaceX a little bit too rich. So we know what I'm going to say later on. Welcome back in, my friend, for headlines and head scratchers.
How's the face today, brother? Is it any less red, or am I?
You look like Bob the Tomato from VeggieTales still, but it's not your fault, dude.
I was trying to remain still during the whole first. Did you ever see? Why am I drawing a blank here? Footloose.
Yeah, but forever ago, and I don't remember that shit.
Yeah, it's like I feel like Baby in the Corner here. Like at the end, like it just got pushed in the corner.
Baby in the Corner is Dirty Dancing, not Footloose.
Dirty Dancing. Damn, I screwed it up. Whatever. Move along.
Look, rolling on to Google this. We got headlines and head scratchers. Our time in the show where we visit things that make no sense, visit calls that we made that were right or wrong. We own our mistakes. We celebrate our victories together, and we just talk it through. I just sat down and did an amazing podcast. Everyone look out for it, with Louis Ruggiero on Nothing's Off the Table on gambling addiction, prediction markets. And lo and behold, we predicted at the beginning of this year that the prediction markets are going to implode. And sure enough, we're getting more and more evidence on why, because people are cheating. It's insider trading. It's a platform designed to incentivize bad behavior because there's no regulation. And
I
Google
don't think
employee,
people would cheat. I think that's that's an overstatement. Really?
Cheaters cheat, bro. They just find new avenues to do it. So they're cheating here. Google it. It's happening.
That's there should no surprise to anyone, right?
No, it's not. So it's just a matter of time. Where's the tipping point that gets hit before regulatory oversight comes in and squashes this market? The poly market and Kalshi now generating up to over $60 billion worth of wagers this year alone. Insanity.
And I have to imagine that the level of, you can't even track the level of cheating. What they put in the headlines and what's caught is I don't say even the tip of the iceberg. It's a little shard. I mean, it's ridiculous.
Yeah, no, you're absolutely right. The same thing happens with on Wall Street with insider trading. Those that get caught, there's probably 10 others that are doing it just as bad or worse.
Yeah.
So
all right,
WTF.
ETFs.
Yeah,
I know, ETFs are outnumbering stocks now. They're just you can't walk around the corner without bumping into one. So.
Yeah, they're multiplying like gremlins. If anyone remembers that movie, pour water on them and Gizmo just grows into more. It's insanity now, right? There are close to 5,000, almost 6,000 ETFs, more than the publicly traded number of stocks out there. Tell me, how could that many ETF managers possibly think they're doing something different than 4,999 other ones? Not possible.
Yeah, aren't they all just because they all share, right? I mean, not all of them, but there's so many that have to overlap.
Share, like nursery school share, or they're just
like overlap. It's
Yes.
like I know that there's certain ones that are maybe defined, but there's got to be a lot of overlap in those ETFs. No.
Yeah, there is a ton of overlap. I think they're just a bunch of people that we would call closet indexers. So their ETFs look like the index. They're not really saying, they're not doing anything unique, but they're charging an expense fee like they are doing something unique, picking stocks. So what's the net takeaway? Be careful buying the latest, greatest ETF. Next week, we're going to feature a very truly differentiated ETF. My friend Keith Fitzgerald launched with Nicholas Wealth and David Nicholas. That's what we're going to endeavor to do. We said it maybe a year ago that we would find ways to help you sort through all the noise in the ETF space. Yes, Vanessa Michelle 4663. Good to see you. I can't remember. It's the Equal 8 one. I'll find it and bring it up. It's one of these small things that has escaped my mind. It's not the expanded software ETF, the IGV. It's an Equal Weight one. I want to say that it's just like the Equal 8 S&P 500 one. So it's going to start with an R. It's not RSV, but it's something similar to that. And I can't remember it off the top of my head. So
it wasn't the IGV. I swear I thought that's what it was.
No, it wasn't the IGV. I'll have to figure it out before next week's show, or tweet at me and I will answer later tonight with the right ticker. But we got some hot tips before we wrap up with 4 minutes to go in the big skinny. Let's call it the hot skinny for a second.
All right. This one, hot tips. I got to be honest with you. I had to go look and see what tips was. Of course, Treasury inflation protected securities. You lost me.
Yeah. So it's basically buying, if you go to the bank and you buy a CD and it's got a guaranteed rate of return if you hold it to maturity. Tips guarantee that rate, but they say it gets adjusted for whatever inflation is. So if you buy them and inflation goes up and you hold it to maturity, you get an even higher yield on it. The problem is most people can't hold on to a stock for more than 6 months. There's no way they're hanging on to Treasury inflation protected securities all the way to maturity to earn that yield. And the other part is, if inflation reaccelerates, all you're getting is the inflation. You're going to match it. If you actually invest in really well-performing stocks, you can outpace inflation. So I don't think these are a great thing to rush and buy when you're freaking out because there's going to be more inflation, because the performance just doesn't back it up. Especially if you decide to punt and not hold them to maturity when the bond or the CD that people are familiar with at the bank comes due.
Well, my next question was going to be how do you go and actually buy one of these? But I don't think I really care. So we'll just
there's ETFs for that.
Oh, more ETFs. Okay.
Yeah. There's an ETF for that.
Now, is that a good ETF or a bad ETF?
No, they're good ETF. It gives you exposure. But my thing is why bother, right? Yeah. Go get your 5% in treasuries and then trade equities to earn another 5-10% somewhere else.
All right. Chips Ahoy. Let's talk about cookies.
The worst cookies on the market are Chips Ahoy. I hate a crunchy chocolate chip cookie. They got to be soft and gooey and
no. That's a good debate
in the middle.
We have more than 3 minutes because I'm a crunchy cookie guy, and I'm not saying Chips Ahoy.
You can go take your
cookies. I want them crispy, well done, and crunchy, not those soft and gooey or cake ones. Those are just gross.
Yeah, we can't be friends anymore. Take your famous Amos and go retire down the road, my friend. No way. But Chips Ahoy, we're talking about semiconductors here, making up the greatest percentage that they have ever in the S&P 500, the sector weighting about 18%. My response to this is going to be a rebuttal of all the bubble babblers who are going to say, it's too big. Tech can't go up any more than this. Semis can't go up any more than this. They've been the best performing sector for the last decade. People have been crying for 2 years running that tech's concentration in the S&P 500 is too high. And guess what tech has continued to do? Outperform. Semiconductors aren't going to stop anytime soon because they are the oxygen of the digital economy. We can't live without them. It's not just AI. It's everything around you. The digital cameras, the microphones, the laptops, the cell phones, the iPads, your car. Automotive components now, 30% of them are comprised of chips. So chips ain't going anywhere. It's going to be a $2 trillion unit market in the blink of an eye. So Chips Ahoy, take your crunchy, crispy chips and go get soft ones, wafers.
Now, this I know we've been talking about for years. Just chips are in everything.
Yes.
And just nothing but continuing.
Nope. We got about a minute to go here, and we got two things to cover. Get to work. Metaverse.
clearly Zuck is just trying to pay for his AI budget out of subscriptions, just more subscriptions and more subscriptions. I know that there's a new one now for their AI bot. Is that true?
Yeah, and it's Instagram Plus, and there's some other Plus subscription for $4 a month or $4.99, and you get special features. Who cares? I apparently I've made it a mission in my life to speak negatively about multi-billionaires out there, Mark Zuckerberg, Elon Musk, which we'll do that in a second here. But look, you've always been the product on Facebook and Instagram. You're always going to be the product. And now he's just trying to squeeze more blood from that same stone instead of advertisers now and selling you to the advertisers. He's trying to sell you on access to a platform that had been free. Not a fan of Zuck, not a fan of this plan.
All right. Well, good thing for Facebook, and that's all I use, man, is Facebook, and that's, I'm just a voyeur. I don't actually use all that stuff. Do you?
Nope. Never been on Facebook. Never going to be on Facebook.
Yeah.
So before you run, in 60 seconds or less, we predicted this. I said it earlier, big IPO bust this year. I am on the record saying we're going to see a bunch of them. It could be SpaceX. It could be Anthropic. It could be OpenAI. They're all coming to market. I will tell you this. SpaceX could be the one that busts first before it booms. If you think I'm crazy because there's so many people clamoring to own this, we did an interview that we released with Dale Smothers today. He's a wealth manager based in Kentucky, and he said farmers in Kentucky are calling up and asking for an allocation to the SpaceX IPO. That screams of a trap, my friends. There are so many things wrong with this. We may have to give some time to next week's episode to breaking it all down since we ran out of time this week. All I want to say is don't believe the hype, and more importantly, don't buy into it. Just be patient. You're not going to miss out. There's going to be an opportunity to buy SpaceX way cheaper than it trades coming to market and in the first few days of the market, and we'll be ready to tell you when that time is. But my, oh my, please don't violate the golden rule in IPO investing, which is buying up at any price on the IPO day, because retail investors are the ones left holding the bag. This is for venture capitalists to liquidate and get their gains.
You said about 3 to 6 months out is probably the best opportunity.
It is. So we'll talk about 3 to 6 months. I think it's going public on June 12th. That's what they're angling for. So 2 weeks from now, June, basically, you could get an early Christmas present by getting a great dip buying opportunity in SpaceX. So that's what we'll focus on. All right, my friend, another episode in the bag, number 60. That's right. We are churning out more episodes, more insights, doing sit-down interviews with individual investors, 20 to 25 minutes long. Check it out on our YouTube channel if you haven't subscribed there yet. And we'll meet you back here. Same bat channel, same bat time next week, Thursday, 5 p.m. This is the Dodd Man and Lou, and not the UCF Knights. We're out.
Go Knights, charge on.
Go Gators.